Welcome. Within this video I would like to talk about system parameters. So it doesn't matter which trading system we're talking about, whether it's a system based on price reversals, on price ranges, on trends, or pullbacks, but any kind of trading strategy has basic parameters which need to be in balance in some way or another. So we talk about the win-loss ratio, yeah. So the number of winning trades against the number of losing trades. We talk about the risk return. So what's the potential loss compared to the potential profit? We also talk about the frequency of trade setups. Yeah, do you get a lot of trades or don't you get so many trades? So these are all basic parameters. And if you do research and you do a lot of testing, you will find that there are different categories of trading systems. Yeah, there are some which, for example, have a very high win-loss ratio of 70 or 80%. However, the average loser compared to the average winner is very high, which means that they may take a few pips on each trade, and most of the time that works. However, if they have a loser, the loss in pips is significantly higher than what the profit per trade was beforehand. So a curve for such systems may look like, it goes up, bang, correction. Goes up, bang, correction, etc. So you have to be very careful also when it comes to system sellers who try to sell you a Martingale system. Remember that the Martingale approach implies that when the trade gets against you, let's say you're long and the price goes down, then the system increases and buys another lot. And then, it goes down again, it buys another lot. And then in most cases, actually the price recovers and, the system seems to recover. However, those systems don't work in the long run because eventually there will be a big blow up where you have different trades in one direction and actually the market doesn't retrace back to the mean. So that's very deceiving. It's very dangerous. Don't trade Martingale systems because they will work for some time and eventually blow up. Doesn't make any sense, and be careful when you see systems which are based on Martingale. But even if you leave Martingale aside, you have some systems which have this kind of constellation. So high win-loss ratio, but a very bad risk-reward ratio. Then you have systems which maybe have not such a great win-loss ratio, maybe only 40%. So only 40% of trades are actually profitable, the rest is losing. However, the average win per trade is significantly higher than the average loss per trade. So there could be different losing trades, but once it's a winning trade, it can balance a lot of return in one go. So, for example, many trend-based systems have this kind of characteristic where the win-loss ratios are great, but however, if you catch a trend and it goes in your favor and you can ride it for some time, then there can be an expected positive value. And then there are systems where everything is kind of in balance. These tend to be good systems where you have a good win-loss ratio of maybe 80% or higher. And also the average loser versus average winner is quite balanced. These are good systems. But just remember one thing. So the actual transition of winning and losing trades. So let's say you have 100 trades, okay? And there are some winners, some losers. Remember that most of the time, from your perspective, the distribution of winners and losers is random. Okay, that means that sometimes there's a good run and there are different winners in a row. Sometimes there's a bad run and different losers in a row. And then this, of course, leads to drawdowns. Yeah, so every system will have some kind of drawdown. If you have more losing trades coming, or on average, the risk reward is lower, then suddenly, your account curve goes down for some time. Now, remember, however, that you should be careful with regard to which kind of factors you can actually analyze the draw's conclusion from, and which kind of factors you cannot do so. And then, for example, if you have a system which is generally good, but then you get nervous when there's a drawdown and you start to switch it off, you may even kill the whole system because maybe there was just a phase where it was coming back. Now, allow me to comment on the topic of trade frequency as well. If you have a system which has a good win-loss ratio, a good risk-reward ratio, and a good trade frequency, this is a very good indication. Because most systems you will see which fulfill the conditions of either a good win-loss ratio or good risk-reward ratio, they will actually then suffer on their trade frequency side. So that means that, let's say, if you want to have a system with a good win-loss ratio, then suddenly the number of potential trades decreases, and sometimes even it only does a very low number of trades, maybe every few weeks and so on. This is a big problem because, of course, you want to have a system where the trade frequency is also acceptable. This is a very important factor. However, you then have the other extreme, for example, where you have minute chart scalping systems which do a lot of trades, but then the overall risk-reward ratio is not so good. So there can be suddenly a lot of trades in a row which are losers and lead to a drawdown. Now, last but not least, in the best case, your system has some kind of self-optimizing components. Yeah. So we're talking about fourth generation approaches where the system is not completely intelligent but has a component that it is adaptive to some point, that it does not just trade through the different market periods blindly, but actually adjust in one way or another to changing market conditions. And as I said at the beginning, in the market environment of today, we often have only a few months of one market mode and then a switch to another. So if you, for example, have a portfolio of different strategies, and then there are some strategies which have a self-optimizing component, that's a very good idea. Because there may also be drawdowns, however, you know that the system will not just blindly trade one idea, but could even adjust in one way or another to the changing environment. So to give a very simple example as well, sometimes the market is in a ranging mode for some time where there are boundaries, but then it breaks out and then, for example, does a trend. In the very primitive case, if you have a trend trading system, then it gets whipsawed in the ranging mode and it tries to trade the trends and it loses. But then when the trend comes, it can win. And the opposite, let's say you trade the range-based system and trades the range, then you may have a nice profitable phase, but then suddenly there's a trending mode, and there are different losses. So in the best case, you have a portfolio of strategies, and those strategies also are in one way or another adaptive to the market mode, so that your drawdowns are manageable.